event. This is card news. We're waiting for the event. Yeah, when you see an opportunity like this, you take it. Yeah, we're waiting 2 seconds before the event. Let's see. Let's watch. It's gonna drop. Card news. Okay.
If you have been blowing your Forex trading accounts back-to-back or losing your prop firm challenges, this video is for you. First of all, the only reason why you would blow an account or lose a challenge in the first place is if you practice poor risk management. And I get it. You want to turn your $100 to $1,000 in a short period of time. Let me tell you your problem. Your problem is that you do not understand how to properly plan your trades, manage your trades, and practice a good risk-to-reward ratio when trading. It is still possible to flip that $100 to $1,000. You are only doing it wrong. Let me explain how you can do this the right way. Look at this. You have a capital of $100. Let us take, for example, you use our signals from our Telegram channel to place your trades. We already have an average win rate of about 60 to 70%, which means that for every 10 trades we take, we will lose about 3 to 4 of them and win about 6 to 7 of them. So you want to flip this $100 to $1,000 with our signals. Yeah? What you need to do is to first of all define your risk. Do not define your risk by using lot sizes only. No. Define your risk by using a percentage of your account. Don't go about using 0.01 lot size on every trade. You will most likely move very slowly. And of course, don't just carry a big lot size on every trade. That is why you blow your account in the first place. I personally follow a rule called the 10-trade rule. This rule was taught to me by my mentor. And what this rule is basically all about is that you should divide your capital into 10 places and risk each division of your capital. That means if you are using $100 to trade with our signal, you should risk $10 on every trade you take. So now that we are done defining our risk and we have decided to risk $10 on every trade, the next thing to do is focus on the risk-to-reward ratio, and what this simply means is that we should make sure we are not risking $10 to make $10 or something lower. It means we should be risking $10 to make $30 or $50. A realistic risk-to-reward is risking $10 to make $20 on a trade. This is extremely easy to achieve, but on our channel we aim for nothing less than 1:2 and this means that for every $10 we risk, we are expecting $20 as a reward when we hit TP. Every week we drop an average of 12 signals on the channel. On very good weeks we have an 80% win rate, and on very bad weeks we have a 60% win rate. So now, let us assume we are always having bad weeks, and we only win 7 trades out of 12 trades in a week. With a 1:3 risk-to-reward, we can flip that $100 to $260 in a week, and here is the breakdown. So we have a capital of $100, right? Let us assume you took our first trade and successfully hit TP. That means you won $30, you have a balance of $130. You took the second trade and it was a loss, and you lose $10. You have a balance of $120. The next trade was a loss again. You have a balance of $110. The next trade was a win. You have a balance of $140. Trade number 5 was a win. You have a balance of $170. Trade number 6 was a loss. You have a balance of $160. Trade number 7 was a win. You have a balance of $190. Trade number 8 was a win. You have a balance of $220. Trade number 9 was a win. You have a balance of $250. Trade number 10 was a loss. You have a balance of $240. Trade number 11 was a loss. You have a balance of $230. And lastly, trade number 12 was a win, and you have a balance of $260. Can you see how we successfully flipped $100 to $260 in a week by winning 7 trades and losing 5 trades? This is what a win rate of 60% will get you. Now imagine what a win rate of 80% will get you. This is exactly the reality of trading. You cannot always win, but at the same time, You cannot always lose unless you are cursed anyway.